Hey guys, Jessica here. Today I wanted to talk about Roth IRAs as tax shelters for billionaires and whether such a strategy makes sense for the rest of us normal non-billionaires. There's a ton to cover here. First, how they did it, how billionaires like Peter Thiel managed to get to such astronomical valuations of their Roth IRAs, and whether or not such a strategy makes sense for the rest of us. But I'll also cover a bit about the pitfalls of this, because if you do go down this path and you do any of it wrong, basically the IRS will not be happy. And while rich people have tons of tax lawyers and accountants to be able to help them with IRS audits, you and I don't have access to the same. So a couple months ago, ProPublica published a story here about how Peter Thiel, a well-known venture capitalist, managed to stuff his retirement account with investments in early-stage pre-IPO startups, and that over time, this account managed to balloon to be over $5 billion in value. And he'll basically never have to pay taxes on any of those gains as long as he waits until he turns 59 and a half to cash out the money, which for him is 6 years away. So before we break this down, it's worth talking a bit about, whether or not this is right, whether or not it's right for billionaires to be able to use strategies like these to not have to pay billions of dollars in taxes. And this specific question is actually making its way through Congress as we speak. But the thing that I want to leave you guys with is the fact that while it's possible to take this specific strategy and make it a lot more narrow, close it down, there are a gazillion other strategies just like it out there, all of them perfectly legal, many of them as boring as Roth IRAs. And while these strategies exist, then it's our mission to make them available entirely for free to normal Americans, especially people who are in their 20s and sort of just getting started in their careers. So to break down what happened here, basically Peter Thiel went and opened up a Roth IRA, or Individual Retirement Account. And what a Roth IRA allows you to do is it allows you to take money from your paycheck, so the money left over, after your monthly spend, take that money and put it into an account. And this account can be invested in various different things like stocks and bonds and stuff like that. And then hopefully, because the money is invested over a long period of time, the value of the account will keep going up. And as long as you leave the money in there and you don't withdraw it until you're 59 and a half, you're old, you're retired, if you wait until then to spend the money, then you don't have to pay any taxes on any of the gains. Basically, to put numbers behind this, let's say you put $100 in your Roth IRA, and then over a long period of time, it grows into $1,000. And you pull this money out when you're old and you're retired, you don't have to pay any taxes on that $900 gain. In general, Roth IRAs are a pretty sweet deal, and I definitely recommend them for people who qualify. Now, most people invest their Roth IRA money in stocks, bonds, mutual funds, ETFs, things like that. But in the case of Peter Thiel, he went and invested it in private pre-IPO startups. And over a long period of time, these investments did well, and boom, $5 billion Roth IRA. So you might be thinking, easy, I'll just take my Roth IRA money and then invest it into pre-IPO startups. I hate to break it to you, but this strategy is actually pretty difficult to pull off for 3 reasons. The first one, access to deals. The second one, high fees. And the third one is that this thing is actually pretty tricky. Number 1, access to investments. So the first piece is whether you can get access to the deals, to the startup investments that are going to be returning, say, 50x, 100x, like Peter Thiel did. Because you can't just invest in any early stage startup. You have to invest in the ones that are going to do really well, because otherwise you'll be looking at a portfolio value that would probably be closer to zero than $5 billion. First of all, in most cases, to access the best deals, you have to be an accredited investor. And the definition of accredited investor is you've been making $200K for many years, or you have a net worth of over $1 million. Then, even if you are an accredited investor, even that doesn't guarantee that you'll have access to the best deals. Because the thing is, despite the fact that, tech startups are all about algorithms and machines, you'd be really surprised to know how much the early stage startup funding process is all about who you know. It's about people networks. And because of that, it's only a small handful of VCs and rich people who get access to the best deals. So I want to show you guys a bit what I mean. This was an analysis done by Correlation Ventures, which basically shows that a full 65% of VCs lose money. Like, it's their full-time job to invest in startups, and still they're consistently losing money. The ones who make good money, Peter Thiel money, is this tiny handful of funds on the right that return 20, 50x returns. And it's always the same names: Sequoia, Bessemer, NEA, Kleiner, etc. This isn't an accident, and one of the main reasons is the network. The best entrepreneurs flock to the best VCs because the best VCs provide the network as well as credibility. And so it's this reinforcing cycle. Long story short, in venture returns, it's about access to deals, which the vast majority of normal people are excluded from. Number 2, high fees. So the second thing to talk about is fees. But before we even talk about fees, it's worthwhile to talk a little bit about alternative assets in general. So investing in a private startup or investing in crypto, basically things outside of the normal stocks and bonds that you get on public markets, those are alternative investments. And the thing about alternative investments is that they are more risky. They might have a chance of being worth a ton of money, but there's also a decent chance that they go to zero. On top of that, they're not super liquid, meaning that it's a little bit more difficult to sell them than stocks and bonds on the public markets. And so if you really needed money in a pinch, it's harder to get money out of those investments. And because of both of those reasons, usually it's a good idea to keep alternative assets as a relatively small percentage of your overall portfolio. This has to be money that you don't need on a day-to-day basis, because if you ever needed it on a day-to-day basis, it would be a lot harder to get money out this way. So I'm going to use hypothetical numbers here, but suppose you had $50,000 of money to potentially invest. And let's say you wanted to put 10% of that money into alternative investments, so $5,000. So there are only a handful of companies out there that allow you to invest your Roth IRA money into alternative assets. You can't do this at a normal Vanguard or Fidelity. You have to be looking for a company that allows you to do what's called a self-directed IRA. So I took a look at 2 companies in this space, Rocket Dollar and AltoIRA. So for a $5,000 investment, Rocket Dollar charges $180 a year for its lowest tier product, which works out to be 3.6% of the total portfolio value. And for AltoIRA, they charge $250 a year for its lowest tier product, which works out to be 5% of the total portfolio value. And this is not even including the one-time, setup fees and investment fees. 3.6% and 5% are ginormous account fees. Compare this with Vanguard and Fidelity, where you could get a Roth IRA entirely for free. And so if you end up going with a self-directed IRA, it ends up being a huge drag on returns. You'd have to have investments that return way, way above what you can get with Vanguard and Fidelity for this to end up making sense. And of course, none of those returns are guaranteed. On the other hand, if you had $1 million to invest and you wanted to put 10% towards alternatives, that works out to be $100,000 that you could put into a self-directed IRA. That works out to be 0.18% and 0.25% respectively, which is way, way more reasonable than the 3.6 and 5% I was talking about earlier. And the reason this happens is because Rocket Dollar and AltoIRA charge fixed fees. And so as the value of the portfolio goes up, the percentage of those fees goes way, way down. And it makes a lot more sense basically for people with large portfolio values. Number 3, it's tricky. As if all of this wasn't enough, there's still the IRS to deal with. And there are a bunch of laws around self-directed IRAs about things that you can't invest in. So a few big ones. You can't go and invest your Roth IRA in a startup that you found and that you work on. Rental real estate also can be a bit tricky. And a lot of this has to do with a prohibited category called self-dealing. Another thing that you can't invest in is collectibles, so no baseball cards or anything like that, and a bunch of other things. All this to say that on top of everything else, you have to be pretty careful. Okay, so I know that sounded pretty doom and gloom, but there are some silver linings. The first one is that Roth IRAs are still pretty amazing. The fact that you can go to a normal brokerage and invest in a ton of stuff already, all commission free, is really amazing. And on top of that, those tax savings are a huge win. In addition, you can still invest in alternative assets without having to use the Roth IRA strategy. You can take, 10% or whatever percent of your portfolio that you feel comfortable with, and even if it's a small number, you can now put that into alternative assets via your normal investments. And I think the really cool thing is that some companies are now waking up to the fact that it's really great to have their customers be early advocates, early investors in their startup success. And you're seeing now more and more of these platforms like WeFunder or Republic allowing people to get in on startups that they really believe in. Again, as with anything in investments, make sure you do your homework. Make sure you know the company well, you know and like the product, you know and like the team. But in general, I think that it's a pretty cool thing that the private markets are now more and more accessible to normal people, that it's not just for rich people anymore. All of the above will get you a big chunk of the way there. And the rest of the conversation needs to be about why only the richest people get access to the best deals, why the fees are fixed, again, advantaging the rich. And it's about shining a light on all of this stuff that we can get the ball rolling in making change. And that's it. If you want us to take a look at your specific situation, whether this strategy makes sense, and generally other optimization strategies, sign up on our website. It's linked in the description below. We do it completely for free. We're a startup on a mission to take the tax and financial optimization strategies of the super rich and make it available to everyone entirely for free. By the way, there's a ton more stuff that you can be doing with Roth IRAs. So all of them perfectly legal, things like backdoor Roths and mega backdoor Roths, all of which can be huge tax wins. So if you guys are curious about this, let us know in the comments and we'll try to make more videos about that in the future. Other than that, if you got value out of this video, please hit the like button and subscribe for more optimizations. Thanks.